Have you heard of mortgage points? Want to learn more? We'll tell you what they are, why you might want to buy them, and how to figure out if it's a good idea. What is a mortgage point? Imagine you're buying a house and need to borrow money, like $100,000. You can get that loan, called a mortgage, from a bank. But the bank isn't in the business of giving away money for free. They charge you interest, which is extra money you pay over time for borrowing their money. The interest rate is the percent of the loan that you pay each year. Let's say your interest rate is 4%. That means if you borrow $100,000, you'd pay $4,000 each year for the bank to let you borrow their money. Sometimes you can pay a fee to the bank to get a lower interest rate. This fee is called a mortgage point. A point costs 1% of your loan amount. On a $100,000 loan, 1 point would cost $1,000. So if you pay that $1,000 to the bank, they may lower your interest rate by 0.25%. With that little bit of math, we know that $1,000 is worth about $100 a year in interest savings. If you bought a point and your interest rate went from 4% to 3.75%, you'd save $25 a month on your mortgage payment. Why buy points? Now that we know how much a point costs and how much it can save us, let's talk about why someone might want to buy a point. First, your monthly payment will be lower because the interest rate is smaller, so you'll pay less each month. Second, you can save money over time. If you plan to stay in your home for many years, this little bit of savings adds up. Third, you might be able to lower your taxes, but you should ask a tax expert to be sure. So now you know what a point is and some of the good things about it. Of course, there are some not so good things too. You need to pay more money when you get the loan. If you don't have the extra cash, a point might not be a good idea. Also, if you move or pay off the loan early, you might not save enough to make the points worth it. Finally, you could use the money you spend on points for other things, like a bigger down payment. A larger down payment can lower your loan amount, which can lower your monthly payment and the total amount of interest you pay over time. How do you know if buying points is a good idea? Figure out how long it takes to break even. Break even is when the money you save equals the cost of the points. Here's how to figure it. Step 1. Find out how much you save each month with the lower interest rate. Step 2. Divide the cost of the points by your monthly savings to see how many months it takes to break even. Now you know how to crunch the numbers to figure out if buying points is a good idea for you. There's no one answer for everyone. It depends on your situation. Talk with your family and see if buying mortgage points makes sense for you.